Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenborg.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are they reading my mail? Listening to the show? There's an article in the mailbag, quote, life and annuity illustrations fool clients, advisor tells regulators. Welcome to the party. And are we slipping into a recession? Are we going to use the R word? Is it inversion or uninversion that's key? And is the Treasury becoming an activist and becoming Dr. Doom? Neural Rubini says that the Treasury is now, quote, an activist Treasury issuance with their bonds. He calls it ATI. It's like Operation Twist, and they're or similar, and they're manipulating the interest rates and the yield curve. Well, haven't they always done that? And jobs came in soft, and so did real estate. So are we coming in for a soft landing or a hard landing? And Kamala's new home buyers problem to fix the home buying problem so people can actually afford their down payment. Give everybody $25,000 as help for your first down payment. Here's the problem, these politicians. I'm not taking shots at Kamala. It's on both sides of the aisle. These politicians are well, I was going to say something, but that's probably not appropriate for the show. Unfortunately, these politicians don't get it. So if you give everybody $25,000 to go put a down payment on the house, what do you think happens to house prices? They just go up by 25 grand or more. Now you got a little bit more demand. It's almost like ZIRP, the zero interest rate policy. We took interest rates to zero. That's what caused real estate prices to go through the roof. So it was the initial the Fed manipulating originally that actually caused this big housing crisis. When you have manipulation, you skew economic data. You don't get good feels. All right. So, and by the way, stay tuned because we have a special guest. We've got Alex the Greek, Alex Koutoudis, and he actually did a bunch of research. He's actually a consultant for Revere, and he actually did some research going back decades and looked at these various patterns, and he found a repeating pattern in history that is actually setting up right now. And it kind of outlines what is the highest probability, what's very likely over the next 3 to 4 weeks. It's short term. It might surprise you. You just might surprise you. Are you bullish or bearish? Well, what is this telling us? We're going to get into that. But anyway, let's get right down to it. This life and annuity illustrations fools clients, advisor tells regulators. Folks, that's what I've been saying. When you have caps and you have these limits, they make it sound like you're going to get about an 8% return, right? You know why they always show you an 8% illustration? Because that's the maximum they can show you, right? But they're mathematically built to pay you between 4, 5, maybe 6% if you get lucky and time it just right. But that's also going to be the issue, in my opinion, with these buffered ETFs. They're not a bad tool. They're just going to be overhyped, and they're going to overhype the returns just like they did with these indexed annuities that now everybody's pissed that they've got, and now they don't like them anymore. And now, are we slipping into and by the way, that article is in the mailbag if you'd like to go read it. And are we slipping into a recession? And are we inverting or uninverting? And there's a great article in the mailbag that talks about that. It says, you know, how bad are recessions for stocks? Well, the average stock decline during a recession is 36%. Bear markets are rare outside of recessions. And when they do happen outside of recessions, they're slower and quicker. Well, folks, looks like we're heading into a recession possibly. Unemployment claims usually start rising 11 months before the recession, and new home sales begin falling 2 years before recession. So what do we have now? Unemployment has inched higher since bottoming 2 years ago. So unemployment's been going up right in time for recession, and the yield curve has inverted every recession since 1960. Folks, but it says almost 2 years the curve inverted, the longest on record. A more accurate signal is when the curve uninverts. When the curve uninverts 2 months ahead of recession on average. So it's really the uninversion that's actually a closer, better short to midterm indicator. The inversion is a longer term saying, get ready, look down the road. By the way, the yield curve is getting very close to uninverting, and that's with that manipulation of the yield curve that Dr. Doom was talking about. Both of those are in the show notes you can read. And he did this article did give one caveat that COVID messed up the set in stone indicators and kind of threw things out of whack. But in any event, here's something that people may not know. The S&P rose 7 in the past 13 recessions. The National Bureau of Economic Research, NBER, the scorekeeper, the problem is it moves snow as the recession moves slowly. So we feel things in real time when that economic data actually occurs. In other words, these indicators are lagging indicators. So the Great Recession actually began in December 2007. The market didn't roll over till months later, but the National Bureau of Economic Research didn't officially call it a recession until December 2008. So once they actually told you it's a recession, the market's already down 35, 40%. Bob's your uncle. How did that help you? How did that economic data help you, right? I'll tell you how it didn't. It's a lagging indicator. That's why you've got to use the technicals so you can see things change in real time, and it's about relative strength. All right, so we've got both of those articles in there. They're very interesting, and I do want to get to the mailbag, and then we're going to go dive right into the markets because the markets the last 2-3 weeks have really kind of gotten a little exciting. You got a strong pullback, and all of a sudden we're getting a pretty healthy bounce. The big question is this a dead cat bounce, or is this a resumption of the primary uptrend? We're going to talk to the team about that. All right. On 8/12, MB sent this. Market chaos requires nimble trading skills of Revere Asset Management. I am able to swan, and in parentheses he said, sleep well at night. Thanks, Don and Dan. Me, thank you for the kind words, and you're welcome. Folks, it's not always about a stock pick or a topic. Sometimes it's just about kudos. And so he sent that. I thought I'd share that with you. I like that. That's a long-term client. And by the way, this same person also sent an article that's in the mailbag, and it's about Buffett's current strategy. He's holding a lot of cash. He sold some Apple. Anyway, it's kind of a good article, but basically the takeaway is that there's a lot of, quote, unappreciated risk in the market right now. Folks, there's always unappreciated risk. There's always risk in the market, and if you're not scared and nervous, you don't understand the deal. We need to talk more about your money, okay? Now, one last one, and then we're going to get into it, and this is on 8/4, and R sent this. Hi, what do you think about dividend ETFs such as QYLD, and SVOL for income and downside protection? Appreciate your opinion. Thank you for the daily videos. Me, if you get a 3% dividend, but the stock or ETF declines 25%, do you have a gain? No, you're down 22% still, and you have paid taxes on the dividend in a taxable account. I consider these as reductions of basis more than a true downside protection, and you still need some type of sell rules. You may be more liberal with your stops, sell rules, but nevertheless, you need some sell rules, in my opinion. Folks, during the 2008 economic crisis, the S&P dropped 42% by year end. And they had a 3.5% dividend, right? That dividend was of no value. And it's like that covered call strategy. They always talk about this covered call strategy where you're protecting it's a hedge. Folks, it's not a hedge. Think of a covered call, as reducing your principal. So if I buy a stock at 100 and I sell a 105 strike call for a couple dollars, now my cost basis in my simple mind is not 100, it's 98 because I took in $2 for the call. Once I unwind both the call and the stock, then I'm going to know what my real return is. Because just because I got a 2% call premium or did whatever you want to call it that month, that doesn't mean I got 2% that month. The stock's up or down. It's the net. It's the total return. It's the movement of the stock and the dividend. And that's why it's important. That's why now, if you're trying to generate some kind of cash flow and be systematic about it, and God, I'm going to cringe when I say this, an asset allocator, pie charts are us, buy and hold, then a dividend ETF may be suitable. That's just not how Revere rolls. And speaking of Revere rolls, let's go to Teddy Bull or Teddy Bear. We call him Teddy Bull when the market is telling us it's bullish. We call him Teddy Bear when the market looks like it wants to be bearish, because we are agnostic when it comes to the markets. We let the markets tell us what the probabilities suggest is the most likely move. So Ted, with that, give us the Don's market update version.
Sure. So I'll be taking over the charts today with Don on vacation. Well-deserved rest and break for Don. I'll take a step back and kind of start at the beginning of this recent correction we've had. The market was quite extended at that point, and many stocks that we watch were also extended. So we started coming off, breaking the 8 and 21, and eventually we broke the 50 at one point with a couple closes below. And that's a very garden variety pullback, especially after an extension. We started building a sideways kind of range right here. Let me get that drawing tool. And then this day on FOMC, we popped back above the 8 and 21 exponential moving averages on above average volume. So we saw that as a fall through day or simply an accumulation day. But our expectations were completely broken the following day when manufacturing data started hinting towards a potential recession. And I talked about this with the team. I tweeted it as well. And I noted that, like, with the advent of algorithms, social media, perplexity, and these AI chatbots, the velocity of information has sped up dramatically versus even a decade ago, and definitely 2-3 decades ago. And that leads to more emotional reactions as people are picking up the information and putting into their models or their own views of the market and quickly taking action. And so all of a sudden, we started pricing in recession. So we had an outside day reversal. And I've talked about these before. Usually when you get an outside day reversal where the highs breach the previous day's highs and then engulfs that whole candle, that often signals that you have to start being careful, and usually is a turning point in the markets. And that's what happened. We engulfed, closed below the 821 and 50. We started reducing exposure then. And then the following Monday, that's when we found out that the BOJ started raising rates by 15 basis points. That led to more fears that people are starting to liquidate positions to cover their yen carry trade, on top of recessions, on top of Middle Eastern tensions escalating that weekend as well. And we pretty much had a quote-unquote mini crash. The pundits on TV, analysts, were all starting to be extremely fearful of a recession or of a bigger unwinding. But that ended up actually putting in a low for this correction so far. And after some favorable economic data points, the recession fear started easing. The BOJ said they won't be raising rates for now because of market instability. And that has recently led to this V-shaped correction. And this V-shaped correction right here just shows that there's so many emotions in the markets right now. We reclaimed the 8 and 21. We had a fall through day 3 days ago. And then yesterday, in my video, well, we did an intraday video. I hope you enjoyed that. And what I was alluding to was we're on track for a follow-through day. And that's actually what we got. We had a follow-through day yesterday on a gap. So that just shows the market is extremely powerful. The lows of yesterday were above the 5,500 level. So now you have the psychological level defending that area. You also have this previous, let me just reset this chart so there's not so many lines. You also have this previous breakout level coinciding with the lows of the 5,500 level in the follow-through day. So now that low becomes really key in my view. Coming into today, and I'm going to talk about it on the video. Our key level we were watching is this level right here, this 5550 through 5565 area, which is the highs of this bearish engulfing. And so far, we have a really tight day today. And what that tells me is supply isn't coming to market nearly as much as what one would expect with this being a huge distribution day. So that's definitely a very positive sign. And if we were to build some more tight days above the 5,500 level and then take out this level, the uptrend's really, really on. And that'd be a true change in character and price structure for me. But right now, we're definitely operating under positive expectations. You can't really not after a follow-through day and a follow-through day, as well as being above all the key moving averages. Also, yesterday, we had the 8 cross the 21 EMA as well. And once we start getting these to cross the 50-day, which is in a rising uptrend, that's when we have all the alignment and we're back into a full uptrend.
Yeah, it's called a moving average stack, and the moving averages are starting to hook up. That's really good. Yep. That's the fact that they're hooking up. So,
and if you watched the video, yesterday's gap up was just caused by stronger than expected retail sales, which is favorable in this current narrative because we were fearing a recession. So, and plus stronger than expected Walmart earnings as well. And they were talking about pretty positive outlook for the rest of the year. NASDAQ, pretty much similar situation. It was definitely weaker because of the dominance of the big tech, even more so than in the S&P 500. And we actually are getting above the bearish engulfing high here yesterday and the 50-day moving average. And we have a tight day today. So that is quite favorable. What we don't want to see now in both S&P 500 and the NASDAQ is distribution that comes back into the markets. Because when you have distribution immediately after some follow-through days, that's usually a sign that this rally is likely to fail. So what we really want to hope for is some tight days and then some higher highs as well. That's a quick review of the S&P 500 and the NASDAQ, Dan.
Let me add one point real quick, Ted. Let me add one point, because everybody was cheerleading about the fact that Walmart earnings were so good and that it shows that we're not going into recession. I have a little bit different take on that. Walmart is your deep discount store. It's like the Dollar Tree, Dollar General, whatever. It's when things get tight and people got to save money, they're going to go out of their way and they're going to go to Walmart, maybe not for their meat or their produce, but certainly for the canned goods or the laundry detergent or the stuff that has to be really, really fresh, right? And so more people will go to Walmart away from the higher end retailers. So Walmart having really good, solid earnings actually, to me, points that the economy is softening and the consumer is getting more cost conscious. Call me crazy, but anyway, go ahead.
And then finally, I wanted to add one more thing, and this could set up Alex, if that's the direction we want to go in this podcast, Dan, for his segment. On this day, if you guys want to go back, August 5th video, I talked about potential stopping volume. And what I mean by that is, on the upside, when you start seeing the largest daily spread on the largest up day with the largest volume, that is often a signal that people are flooding in, they're FOMOing, and actually they're capitulating to FOMO. And on the downside here, I noted actually on the video that we saw the highest volume of this correction and also coinciding with the lows of the space and reclaiming the 200-day moving average. Obviously you can't be 100% sure that was the low, but I did hint that could have been at least a local low. We don't know if this will be definitely the low of this recent pullback, but for now it is. And just wanted to point out that characteristic.
And you're saying,
the high falling
and you're
low.
saying that the spreads got wide because people were wanting to buy in, and they're just willing to buy at any price. They're just going to bid it up.
So no, so on the downside, the spreads got wide because people were panic selling on the
Panic
largest
selling.
volume.
Okay.
Yeah. And then so if you flip this chart over, it'd be like if people were I guess,
Right.
FOMOing in and
Okay.
just throwing the towel and saying, I have to get in. And this is almost like people are throwing the towel in and saying, I have to get out with all the fears and variables on that day. And so far, that's put in the low. Because if you think about it, if you get crowded in one side and everyone's out, the price really can only go one way up because everyone's out. So,
so said another way, folks, spreads widen. The bid and ask spread widens when you're having a strong sell-off because people are willing, they just need to get out. And also when you have big volume buying where people just want to clamor to get in. So it's really big moves, and especially at inflection points when you're, right around inflection points. When the market's kind of smooth and docile and not real volatile, the spreads will be tight. Go ahead, Ted.
Yep. So this undercut reclaim sets up Alex well for his historical study. Dan, do you want to go over to Alex?
Yeah. So we invited Alex. Alex, a Greek. He actually used to work for Revere a while ago, but it slowed him down and got in the way of his options trading. But we still love him so much because he's very, very good market knowledge. And so he's a consultant. He's on every call we have in the morning before the market open. We've got 3 calls a day at a minimum. We got the morning call before the open. We've got the right before lunch, before the traders go to lunch in New York. And then we've got one right before the close. And he's on all those calls. And he actually counsels us on we got just a couple of clients, a few clients that have some options, that understand options. And we do some options trading around them. But he actually went back and did a deep dive research the last 24 hours, 48 hours, and he found a pattern that seemed to repeat itself a couple different times, and it might just surprise you because it's contra to what I'm feeling right now. Me personally, I'm nervous. I feel like the market's had a nice bounce after a pretty strong sell-off. I'm scared the market's going to go down. That's my feeling. That's why I have to have rules to overcome, because folks, you've got a little voice in your head that will tell it'll if you listen to it, you're almost guaranteed to lose money. When it's time to buy, it won't feel right. You'll be scared. And when it's time to sell, proactively, aggressively sell, like harvesting profits, you're sipping you're at a cocktail party sipping cocktails. You don't feel like you're bragging how much money you're making. It won't feel right to sell. But that's why you need rules. So, Alex, why don't you explain what you found with this all this back research?
Yeah. So, Ted, if you can go back to August 13th, 1999 on the comp. So you have to do NASDAQ, yeah, because I don't think QQQ was around back then. So August 13th, 1999, weekly. Yep. All right. So this pullback was about 15%, similar to the correction we just had of 16% in a short period of time. And the 4th week hammered, which is when the market closes at the high of the close of the week. So you could see, like, imagine a hammer, there's the handle and then the top part of the hammer. That's what that candle looks like on the right, that blue candle. So Ted, if you can click like 4 times and see what happened after that. 4 weeks later. So we return back to the original 52-week highs in a short period of time. Off that 15% pullback, and it was the 4th week that was the hammer. So it feels like a down week, but it closed on the upper range of the week. All right, let's go to the next date. It's February 12th.
Let's explain that so everybody. So what Alex just said, I don't want that to go over people's head. What he's saying is the week was soft and it was selling off, right? And you're feeling negative. It's a negative bearish week, but then you close and it starts it closes on a positive note. Is that what you're saying, Alex?
Yeah. Also,
Okay.
something to key off of. See that big black line? That's the 40-week moving average. All of these closes occur on the 4th or 5th week above the 40-week. I found 20 other setups that looked like this. The ones that primarily on the 4th week that were below the 40-week didn't work. So I was like, you know what? I'm not going to even add them. I don't care what they did because I wouldn't even want to be in the market if we're under the 40-week, which is the 200-day moving average. And of course, Don's always done studies on the 200-day, and nothing really good happens under the 200-day or 40 weeks. So
it's got to hold the 40 weeks. So it's got to hold the 40 weeks.
Yeah.
Okay.
Well, okay. It doesn't. The low doesn't have to be the 40-week. The close has to be above the 40.
Yes.
That's the key.
Yes.
So you can undercut it, and like we just got flushed. We came close to it, but some of these flush below. I'll show you the dates, but they close above. That's the key. Is the 40-week? It has to be above that. Okay. All right. So the next date, Ted, is February 12th, 2010. So 02/12/2010. All right. So this one pulled back 10% in 4 weeks, and the 5th week had a hammer, outside hammer week, which would have felt gross. And you can see the volume on the bottom. I know that I didn't trade at that time. I was in college, but I can imagine that didn't feel good. So Ted, can you click like 3 more weeks and see what happened after this? Yeah, right back to the 52-week highs. So you're starting to see where I'm going with this. All right.
Yeah.
Let's go to October 17th, 2014. So 10/17/2014. All right, this one is key. So this is what I was talking about. We flushed under the 40-week. The hammer closed right at the 40-week. All right, so Ted, click a few weeks and see what happens. But that was on the 4th week that it hammered. Boom, right back to 52-week highs. Okay. The next one, this last one I want to go over is July 1st, 2016. So 07/1/2016. Yep. All right. Same thing. Flushed under the 40-week, closed at or above that 40-week, and it was on the 4th week was the hammer. So you can click a few weeks and see what happened. Boom, right back to 52-week highs after a 10% pullback, and then maybe off to the races. But that is an exception. Like, I don't know. We don't know what's going to happen. We can go back to lows. Like, I'm not saying this is like a end-all, be-all. That's not how the market works. But history does repeat itself. I wouldn't be surprised to see us go back to highs in the next few weeks. Like, that wouldn't surprise me. Also, I'm being flexible. What if we reject right here and we go back down? This is not an indication I'm going to go all margin, all in because I think it's going to do what those other 4 dates did. I'm going off of what has history done. This is my best odds. This is the 2nd week. From what we've seen, those 4 other occurrences above the 40-week, like we are now, there's a likelihood, better probability that we go back to highs. That's what I'm getting from this. So don't take it to heart.
I'm predicting. No, we've got the disclaimer. Thanks, Alex. That was awesome. So, folks, what Alex is saying is the last 4 times this happened with this same setup, the market rallied hard for 4 weeks. And reclaimed the highs. Now, we're 2 weeks into that. We've come off pretty hot. Remember how bad it felt a couple weeks ago? And now the market's rallied pretty good. And people don't trust it. They're nervous. They just can't get. And what we're saying is, if history repeats itself, we probably got another couple weeks of bullish behavior at a minimum. Now, that can change, and the markets can change. But don't get locked into your mindset or your beliefs. That's that little voice in your head that will tell you how to lose money, your money. Okay? Don't be so bearish that it gets in your way. And you can't be, every perma bear and every perma bull I've ever known have gotten crushed, including my old partner, Dan Kofal, who I love to death. He was a big gold bug. He was all in gold. And it was boom or bust cycles, man. Boom or bust. Just like the economy with the Fed money printing. It's boom or bust cycles. Okay. We want to take out that boom or bust cycle and make it a smoother equity curve with rules. But right now, the markets are telling us they're actually bullish, at least in the very short term. And that also shows by those exponential moving averages that Ted had. Folks, if the 8 exponential moving average is cutting up above, crossing the 21, and both of those are crossing over the 50, what that's saying is the uber short-term moving average, uber short-term momentum is accelerating faster than short-term momentum. That means the probabilities in the next few days mean the market's going higher. That's what probabilities tell us. And then also that the 21 exponential is overtaking the 50. So short-term momentum is bullish, and it's becoming more bullish and overtaking the midterm. That's the kind of setup that you want. It doesn't mean it's always right. And I'm not a gambler, but it means the dealer's got a 6 and you got an ace. Are you going to play that hand or are you going to fold? If you're scared, you may fold. But if you have the facts and you know the dealer's got a 6 and you got an ace, you may hold, at least for a while. And anyway, that's why we have the rules. Alex, thanks. That was awesome. All right, let's go to Connor. And Connor, you're going to update a couple stocks that you brought up last week on the show, and you're going to talk about relative strength, right?
Yep, exactly. Just before I get into it, I just want to say one thing is, finding precedents for individual stocks as well. Alex had a great precedent for the indexes specifically, but even finding these for leading stocks can give you a great edge as well. And it's definitely a good exercise to practice. But yeah, so the segment today, last week on the show, we did our Fab Four, myself, Don, and Ted. We all gave 4 stocks that we thought were bucking the trend, showing relative strength while the market was correcting. And we basically highlighted that you don't want to get scared when the market starts to correct. You want to be proactive and have a list of stocks that are bucking the trend and, showing relative strength, because the expectation is if the market starts to bounce, the stocks that held up the best will perform the best once the market starts to bounce. And of course, that's not always the case, but from history and following leading stocks, that's usually the expectation. So I'm going to go over the 4 stocks I mentioned last week. The first one is Sweet Greens. This is ticker SG. And this had that strong earnings gap in a tough tape, really. And you can see on volume, and you could see it handled out a little bit for 4 days and then shot out of that 4-day tight consolidation. It's resting today, but we continue to see positive feedback in the food-related stocks. Ted, if you pull up a chart of Kava real quick as well, this is probably the leader here, and you can see the strength there. So definitely clear relative strength in food-related stocks. Next stock is Shark Ninja, ticker symbol SN. And this one, again, another earnings gapper. And another quick kind of gold nugget or something I've realized is, in a weak market, stocks that are gapping up on earnings and closing high a day, that's a huge tell, because it's going to be a tougher environment for a stock to not get sold into on an earnings gap when the market isn't friendly. But this one bucked the trend. This is arguably a stage 2.
Wait, sorry.
This
before
is
you go,
arguably
that's what I was going to ask you. Would you take a position here now, or is it extended? So tell us where it is on stage 2 and how you would handle if you don't own.
Yeah, so this broke out of like the stage 1 base around 50/IPO base. If you go to the daily, Ted, this is short-term extended, definitely, but I think it's setting up really good. It had a day 2 higher high, and if it could take out those highs that day 2 on volume, I think that would be buyable. And that 10-day is catching up to price, and that would be a logical place to trail with the stop loss or that high volume close, which we talk about a lot. So that's a way to play it, how I would view it. And then Ted's noting that relative strength line is another huge tell into all-time, into new highs with price confirming.
And it's
then
forming that
next
bull
stock,
flag.
yep, pretty clean bull flag. Next stock is ServiceNow. And this one of the better long-term bases I'm seeing right now, and it is holding above that key 800 level. And yeah, it's acting really well. Short term, you could argue it's maybe a tad bit extended, but then when you zoom out, like Ted was showing the weekly, it's just breaking out of a stage 2 base. So this one's acting really well. And again, it's showing relative strength versus the market.
And in full disclosure, we own that stock.
Yep. And then a sector I mentioned, XBI. I want to focus on the weekly for this one. And this is another, rate cut beneficiary sector, and 100's the key level. And you can see it's really tried to poke its head out above this stage 1 base 3 times now. And so it's starting to come back into that 100 level. And as you can see, when a stock breaks a huge multi-month/year period of neglect, that can lead to a huge move. We want to be focused on stocks that are in a stage 2 uptrend, as history shows that that's where you get the biggest moves. And then looking at some fundamental angles with, AI, biotech has a lot of application use of AI, and versus trying to play an individual biotech name, we like the sector ETF. And if you want to add some juice and octane, you can play LABU, which is the leverage ETF. And just as you know, just a reminder is that LABU isn't an investment vehicle. Any 3 times levered ETF decays over time, so not something you hold months to years on end. So that's just something to know. But overall, this reclaim the 50-day back above the 21-day, maybe a tight inside day, and volume through 100 would be a really good spot. And then going to add one new name. These were the 4 I covered last week, but a new name is StarBucks, SBUX. And this one had a huge gap this week on news that Chipotle CEO is coming over to Starbucks. And if you look at the track record of the Chipotle CEO, he's a proven winner. When he was at Chipotle, the stock appreciated almost 1,000%. And you can see the market really liked this. This was highest volume in years. Now it's formed that post gap flag that we talk about. And a way to play this is, it takes out the high volume close right there. You can take it with a stop at the gap low, which is relatively low risk. So that's an idea for you guys. But great action here. And, this had been a laggard, but once, the volume doesn't lie. So this is definitely back on our watch list and something we're watching.
All right, Connor, is that's all of them?
That's everything.
All right. Well, thank you. And folks, by the way, when Connor was talking about using that leveraged ETF, almost always, whenever you use a leveraged ETF, because they're very volatile, you obviously got to cut your position size accordingly, right? But you also want to chart or do your technical analysis off the single ETF, the unleveraged ETF, because those leveraged ETFs, they're so volatile on the chart, they'll kind of scare you out, or they just look extremely volatile. So it smooths it out on the single chart. And so if you're going to take a 15% or 20% single index ETF, you might do 5 or 10% double or triple. So you get the same exposure with half or a third of the position size. But then once you do that, you still want to chart off the single ETF, because again, charting those triple, it's very hard. It's almost like trying to chart the VIX. It's just very difficult. All right, folks, listen, please, if you like what you heard, tell a friend, tell a neighbor, just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. You can tell them just to put their name and email address in, and they'll get this daily market insight video every night the market is open, and you'll get this podcast delivered in your inbox Saturday morning. We're recording an hour early today. I forgot to mention that at 9:30. Had some stuff going on later. But if you sign up on YouTube, just go to YouTube and just go to Revere Asset. Just search Revere Asset and hit subscribe. You'll get this probably by noon Central Time, because we post this on YouTube before the market even closes. That's how our stock nerds do it. You can also, next to us is a contact us button. You can send me an email and ask me about a stock or a topic you'd like discussed on the show. And you can always, always, always call us old school at 855 Real Wealth. Folks, we'll talk to next week on your money, not their money, your money. Because it's not how much you can make in the markets, how much you can keep.